Joining us now is our silver expert, Mr. David Morgan. You can reach David by going to the Morgan Report. David, how you doing?
Doing great. Thank you, Alan.
How's your weather out there?
Nice fall weather. It's sunny and crisp, like 70 or so. It's my favorite month out here.
My fall has always been my favorite season, but on to silver. I mean, it's been under pressure. I would think we saw a little bit of a pop when Mario Draghi did his thing last week. I mean, this is an environment where the precious metals should be off to the races, and yet down. And gold, I mean, they've taken gold to the woodshed.
Yeah, gold is off a little more percentage-wise than silver as we speak. Usually, I mean, as far as I'm concerned, and this is not about being right, this is not about being stubborn, this is about my analysis, right or wrong. I really think this is a month where we get a turnaround, meaning that, the bottoms for both metals could be tested, but I really think, as I said before, the bottoms are in. The second thing is that any good trader, anyone, especially in these type of markets where pretty much every market out there is manipulated, the powers that be have a lot of control. They got a lot of money, they got a lot of things going for them, but they don't have everything. So when they want to determine what a bottom is, just like back in the Rothschild days, or read Jesse Livermore's book, or, do some market study and verify this. You don't have to take my word for it. You will sell into whatever you want to buy. In other words, if you're going to do some short covering in the silver market open interest is quite large right now, which means all the bets are open. It's like a horse race. The race hasn't been finished yet, and there's lots of bets out there on, who's going to win. And so right now, the bottom, I think, is being sold into to pressure it down to see how much it could take, how much it could force it down. When it can't force it down anymore, and that point will be reached, and where it is, I don't know for certain. Again, I think we've already seen it once at the 1817 level. We've got that huge intraday turnaround. You will see the smart money, the boys that really run this thing, will start to cover. But once they start to cover, they know that then the momentum changes. The momentum changes from going down to going up. And I really think, Alan, that we're going to see that this month. Is it going to be significant? Probably not. Significant enough where you'll see, silver at the end of September, maybe, 20, 21, maybe 22, something like that, with percentage-wise 19, is, a pretty good move up. But more importantly is the idea I just gave. So, time will tell. We're early in the month. We've got a few more weeks, and we'll have to see if, I'm correct on this or not. I'm correct as far as how markets move and how they manipulate them. What I'm not correct, or no one knows, them included, is how much more downside pressure the market can take before basically there aren't any more people to sell to. And that's, at these prices. So we'll have to wait and see.
David, I had a contributor, Andy Hoffman, over at Miles Franklin, and you'd given them a shout-out a couple of weeks ago as a good place to buy gold. And Andy was saying that there's been a total detachment between the paper gold and silver and the actual physical stuff, so much so that there's far more paper than there is metal to cover it.
It's always been that way. I mean, as far as, percentage-wise, it's probably greater now than it's been at other times in history. But that's true of all the markets. I mean, I want to be objective and fair. The basic commodities, hedging system that was originated, I think, was with good intent, but has unintended consequences because it's become a big speculative casino. But you have coverage in all the commodities that's greater than what the physical reality is. That's true of wheat, corn, soybean oil, any of the ags, oil, any of them. But what's interesting about silver is as far as coverage ratio goes, it's extraordinarily high. I mean, it's off the charts high relative to the other commodities. So Andy's right. I mean, Andy and I are fairly close, and he's a good thinker and, good speaker. I've been at several conferences where he and I have both been, speaking to the audience. But, I just want to be clear that this is true of the paper markets. I mean, let's look at the big picture and just get away from metals for a minute. Let's look at the overall derivatives. I mean, the derivatives market dwarfs everything else. And most derivatives revolve around interest rate structures. And the interest rate structures are with the zero interest rate policy, which furthers the exponential problem that we have. I mean, I was looking at Chris Martinson's revamped crash course last night, and repetition is the mother of learning. I mean, I don't know everything, and I like to review this stuff from time to time. And I forget the doctor that wrote the quote. I'm going to paraphrase because we don't have the quote exact, but he said one of the greatest fallacies of the human race is not to understand the exponential function. And what that means is the compounding. It's the eighth wonder of the world, compound interest. But once you get to a certain point, it compounds at such a fast rate that nothing can happen to stop it, and it accelerates. And that's the problem. And we're in that acceleration phase right now. The money supply is going to continue to grow because the debt continues to grow. And this can't go on, in my view, another 7 years or another 5 years. I doubt it's going to go another 3. So we're going to see this thing accelerate, meaning that it's already built into the system. It's part of the system. It cannot be changed. It's the way it's structured. And so the real problem is, the debt markets, the bond markets, and the best hedge against that, of course, are the precious metals, both gold and silver. And so few people know that. I mean, if there was a seminar that everyone had to take on the exponential function of what the debt bomb looks like and what the consequences through history have always been, without exception, 3,800 paper currencies have failed. To think that this one won't is preposterous. Now, will it fail to where you can't get anything for a bushel of dollars? No. Will it be hyperinflation? I doubt it. But it'll be a life-changing event where your middle-class lifestyle is gone. And you're going to look back to the good old days when you were able to, have a lifestyle that was superior to the one that you're living, let's say, 10 years hence for most people. That's what I'm trying to get across. And, it's going on deaf ears again. It reminds me of when I was, at the bottom of the market around the 1998, 99, 2000 time frame. And, I just felt like I was just shouting to the wind. Very, very few people were paying attention. And, again, it's not about being right. I mean, this stuff's just repeating. I mean, this history repeats again and again and again. Only this time, the facts are that it's a worldwide global phenomena. Everyone's tied together. As the dollar goes, so goes everyone. Whether or not the BRICS can circumvent the dollar and extricate themselves from the monetary system when this thing blows up and be, sovereign in and of themselves, perhaps. I don't know. That remains to be determined. And obviously they're trying very hard to make that happen, or at least it appears that way. But in the long run, as I said, it used to be the adage is General Motors goes, so goes America. Well, look at what happened to General Motors. Take a look at Detroit. And I say the bigger analogy is as the U.S. dollar goes, so goes the world.
Great analogy. I always say if you want to see what happens to a country when it loses its manufacturing base, just look north to Detroit. When I first started in the gutter guard business, Detroit was just a vibrant city with a lot of business, and now it really is a ghost town. We're speaking with David Morgan. If you want to follow David, just go to silver-investor.com. Silver-investor.com.
I also believe that in the short term, as we transition to renewable energy, we can and should increase our domestic production of oil and natural gas.
It's just that it will bankrupt them because they're going to be charged a huge sum for all that greenhouse gas that's being emitted.
We're speaking with David Morgan. David is the publisher of the Morgan Report. If you want to go directly to David's website, silver-investor.com. David, what would it take, in your view, to begin what the Austrian economists referred to as the crack-up boom? I mean, they've printed so much money. You know that the dollar will not be the lone fiat currency to survive. I mean, we may have a currency called the dollar 20 years from now, but it certainly won't resemble, at least in terms of purchasing power, the dollar that we have today. But the Austrians believe in what they call the crack-up boom, where in just a short order of time, everybody loses confidence in the currency and it basically collapses. What do you predict that's going to happen to the U.S. dollar?
I do. I think that's the essence of it. It's a trust or a confidence game. And I think, and this is what I think, doesn't mean it'll happen. I hate to always, hedge my bets, but I don't think it'll come from the public. I think it'll come from an entity. In other words, it could be a hedge fund. It could be a nation state. It could be a sovereign wealth fund. It could be a very large investor, but it would be something along the lines of an exit out of the bond market where the Fed is caught off guard, because the Chinese have basically exited buying new U.S. debt, and it's been that way for quite some time. And they've switched from buying debt to buying gold, and that's been going on for quite some time. And they're doing it slowly. They're doing it the way that a professional does. They move into the market slowly over time so that they can continue to buy at the same price and not rock the market. And that's what I'm talking about, rocking the market, where there's such a large sale that all of a sudden the psychology changes from everybody wanting to buy the U.S. debt to wanting to sell the U.S. debt at the same time. Again, to use the old analogy I've used before, it's like a flock of birds flying along very happily going one direction, and they're all in formation. Everything's great. But all of a sudden, out of nowhere, for no apparent reason, they take a hard left, and all of them follow, and they just make this abrupt change. Well, that abrupt change is what I'm talking about. I think that will happen. When? I don't know. But it'll probably be someone that's trying to exit the market in a stealth way, where they're trying to just get out, but it's still larger volume than normal or something. Or maybe there's a computer glitch that triggers in a nation state or through a money center bank, or a computer hack by some entity or something, or some, quote-unquote terrorist group. And that spooks the market, and so the XYZ hedge fund says, "Oh my God, if we have an electronic failure here, I'm getting out of the bond." And they sell it all at the market. We see those big sell at the market orders go. That could trigger others to see that. Oh my God, do you know that John XYZ is selling? Man, that guy knows everything. He's never lost in 20 years. If he's getting out, I'm getting out. And that's what starts it. And it could be that simple, and I think something like that will take place.
Well, ever since Mario Draghi made his announcement last week, the dollar has been off to the races when compared to the euro. But it's difficult to say that it's just against the euro because of what we've seen with the precious metals. I'm perplexed. We made a 52-week high last week because Mario Draghi cut interest rates 0.1%, and then increased the size of the negative interest rate that depositors are having to pay.
Yeah. Well, the best way I can explain it is you go back to John Exter, who was president of the Federal Reserve of New York Fed. And he has an upside-down pyramid, and I was probably one of the first to bring this to the attention of the investing public years ago. It's been updated by Trace Mayer of runthegold.com. You can look at that chart that's been updated by him. It's actually a better analogy than John Exter, because in John's day, we didn't have the derivatives problem that we have now. In fact, there were very few. There were some options out there, but now, of course, it's just insane. But if you look at the liquidity, as people get scared, they go to safer and safer and safer investments. So the ones that are the riskiest to get out of, and then they move down. And moving down the pyramid, the one step before gold and silver is the dollar. In other words, so you're going to sell off, the stocks. And, of course, the stock market's making new highs. I know that. I'm trying to just give it on the radio of how the upside-down pyramid looks and why and how it works. But basically, you go to safer and safer. Well, the safest thing to most people is dollar bills in your hand. If they think there's going to be a bank failure and they've got $4,812 in the bank and they have it all in cash under their mattress or in their safe or buried in their backyard, they feel a lot safer, because if there is a bank failure, they've got a tangible thing, a greenback, that they can go out and spend. And right now, everyone's accepting that. In fact, it's being more accepted. The dollar is strengthening, as you just said. So that's the step before there was loss of confidence in that. And once there's loss of confidence in that, that's when there's the big run to gold, as Trace Mayer's website says, runtogold.com. And that's just the way it works. I can't change it, but I think it's important to know it. You've asked a question. We haven't had this discussion to this level or this amount of depth before. It's complicated because basically it's perception. The perception is I'm safe if I'm in dollars, and that's probably 99% of the population. It's only 1 or 2% that says I'm safest in gold. But it doesn't take a lot of people that get educated in a hurry once the dollar starts to fail to say, oh my goodness, what do I do? And then they come and they again run to gold. So I think we're getting closer. If you look at the pyramid, the upside down pyramid, you'll get a better feel for what I'm talking about. And it's, again, part of the process. So you really can't skip that step. So I'm not that perplexed by it. I understand it. I accept it. But do I like it? No. I mean, I really would feel a lot more comfortable right now if, silver was in the 30s and gold was in the 16, 1700 range. And that's where I think they should be minimally at this point in time with all that's going on in the geopolitical realm with the, war factions going back and forth, these sanctions against each other, the euro basically in a slow collapse. The trust factor, I mean, who's trusting who with this NSA thing? I mean, all these things are still out there. Nothing's gotten any better. I mean, look at how much more difficult it is in world affairs today than it was during the 2008 financial crisis. I mean, things have gotten worse and worse and worse. In reality, the stock market's gotten better and better, and the propaganda machine's gotten stronger and stronger. And if you believe the propaganda out there, people like me are ridiculous. I mean, why would you listen to it? He sounds like a broken record, doesn't know what he's talking about. I've heard it before, and on and on. It's the old boy who cried wolf, And I feel that way sometimes. It's like, why should I waste my time? Because maybe this is going to take place further out than I ever dreamed. Maybe this is going to happen in my lifetime. I really doubt that. Again, coming back to the reality. Why? Because of the exponential function, and things speed up during the exponential function. I mean, if you take a drop of water and let it double every second, and you walled off Yankee Stadium, you put that drop of water in there, how long would it be before you were in the top seat and you were flooded out? Well, it would take 50 minutes. But at 45 minutes, you only have like the whole Yankee Stadium covered with a couple feet of water. So with only 5 minutes left, it looks like you're pretty safe. It's the whole stadium down there, a couple feet, and I'm way up here at the top bleacher. But it accelerates, and so in the last 5 minutes, it goes from a couple feet of water to it completely fills the whole stadium. That's the power of an exponential curve, and that's the power of speeding up. And that's what I'm talking about. And again, that's built in the system. It cannot be changed. It won't be changed. No matter what the propaganda machine throws at you, the reality is that's the truth. And it will accelerate. And since it is accelerating as we speak, I have little doubt that we're going to see this thing take place over the next couple, 2 years. At the longest, I really don't see this thing going, 5, 7 years longer. It can't. I mean, the exponential function is what it is. We're $17 trillion. I mean, look, it took all the presidencies to Bush to get us to like $8 trillion, and then it doubled from 8 to 17 under Barack. So that shows you. Is it Barack's fault? No, I'm not blaming him. I'm saying what administration it happened under, but that's the power of exponential. So when it goes from, 17 to 34, and then 30, where does it stop? And at some point, people holding U.S. debt says, this is never going to stop. I got to get something out of this thing. I got to go to cash. And then when the cash doesn't work, they go to gold. And that's going down the pyramid.
This is David Morgan. Again, for more expert analysis like what you just heard, go to silver-investor.com. David, it's always a pleasure. Talk to you next week.
Thank you.
Thank you.